battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name's Nick Stenger. We are Stenger Family Office. For the past 44 long years, you'll remember it's been our family's mission to help deliver clarity and confidence to secure your financial future. Here we are, episode 211, and we are rolling right through January. Hard to believe, already Christmas come and gone, and New Year, the brand new year, 2026, and we're already halfway through January. This year is going to fly by, and we're watching the markets here at record all-time highs, close to record all-time highs, and been getting a lot of questions about what's going to happen the rest of this year. So I wanted to address some of the commonly asked questions, some of the goals-based planning items that we've talked about on the show in the past. But all that to say, I do, and I have said, and I've maintained the fact that I think we're going to have a correction in 2026, and it could be significant. We have had three back-to-back unbelievable years, 23, 24, last year in 2025, very, very good years. And not just good in the sense that we were up 7 or 8%, good in the sense that we were up double digits pretty much every year now for the past 3 years. And so it's not going to be uncommon. We would not be surprised if we're going to hand some of that back here this year in 2026. Now, there's a couple things going on that we're watching very closely, but we've named the show this week, The Rotation Continues, and that's the lifeblood of a bull market, sector rotation. Well, what's sector rotation or even stock rotation? Sector rotation is the idea that sometimes one sector is up, like technology did really well, but healthcare didn't do so well. That's basically what happened last year in 2025. Well, this year, I think you're going to see this sector rotation go through the rest of the value stocks. You're seeing value actually significantly outperform growth this year in 2026, and that's why we've always had some value stocks in the portfolio. We don't want our clients, certainly not our retired clients, to have everything in growth stocks at 40 or 50 PE multiples. And I have said that depending on what the Fed does, depending on what earnings do this year, you should be careful with these high-flying stocks that have 200, 300 price-to-earnings ratios. Doesn't necessarily mean the companies are all bad at a 200 PE. It doesn't mean their management team is bad or the company's being run poorly. It just means that you have to be careful with what you're paying in a environment like we have with interest rates. Now, there's a lot of expectations that we're going to have cuts with interest rates later in 2026, and certainly the pressure is on Powell here. I guess they're recommending criminal charges now on Powell, which is definitely a step too far. He's not a criminal for not cutting interest rates. Probably what's more criminal is the fact that he didn't raise interest rates fast enough in 2021. And we would not be in the spot we're in today if we got ahead of the interest rate and the inflation moves that happened coming out of COVID. We said that for a long time. We said that he should have raised interest rates in 2021, and we would not have had the bloodbath in 2022. Remember, stock market was down 22% in 2022 as a reaction to increased interest rates. All that to say, I have people today who still say, oh my goodness, Nick, I can't believe it. You keep saying we're going to have a 20% correction. That is just terrible. That's so awful. Yeah, it's a big correction, but you have to remember, put it in context. When in doubt, zoom out. And just look at the past few years. We've had these corrections, and they're not uncommon. We've had these pullbacks, and we've even had some technical recessions. 2022, the summer of 22, we had a technical recession, and guess what? We're all still here to tell the story. The world did not come crashing down. The world is not ending tomorrow because of a recession in 2022 or some sort of pullback in GDP the next couple quarters. So don't lose heart, do not panic, and don't worry about a 20% correction. And I will just take you back. Hopefully your memory is long enough to go back to April of last year, which in just a few short months is a whole year out from Liberation Day. Market was down 19%. So just remember this stuff. Don't panic. Don't think that it's the end of the world and the sky is falling despite what the news is, because I am telling you this today, we're going to have a 20% correction. When that correction happens, it's like clockwork. There's always going to be people that reach out to us and say, well, isn't this time different? Yeah, Nick, I understand Liberation Day and I understand COVID and I understand Brexit and Grexit and 08 and 09 and all this stuff. But this one's got to be different. Well, where did they get that idea from? They got it from the media. They got it from Twitter, from watching too much CNBC. And now they may make a bad decision. They may really believe that this one's different the next time we have a 20% pullback. And I don't know what the news is going to be. I would guess that the next likely thing here is that we are going to see China invade Taiwan. I would not be surprised by that at all. And maybe that's what it is. Who knows? I don't have a crystal ball. I can't tell you what's going to happen tomorrow. Certainly not what's going to happen later this year with geopolitics. But all that to say, I think that could be a story. It could be a story about that we're headed into recession. It could be a story that consumer spending is pulling back. Maybe inflation comes in higher than we think. Who knows what it is? I mean, there could be 20 reasons. And the media is going to say this time it's different. And I'm warning you here today, 6,900 on the S&P. It's not going to be different. It's all going to be based off of earnings times price. That's the equation you have to hold on to. Now, what are the earnings coming in at? Well, you're buying the S&P today off of 2025's earnings at 25 times profit. That's the PE ratio, about 25 times. That's current PE, but we don't really care about current PE because it's backwards looking. We want to worry about what's coming. We want forward PE. Now, at the end of 2026, we were technically trading the S&P on 2026 profits. I'm sorry, end of 2025, we were trading it on 2026 profits. Well, the forward P on the S&P at the end of 2025 was closer to 21 times. That's not radically out of the ordinary. And that's what we based our projection for the S&P for 2025 when we came out in 2024, told you what we thought the market was going to do. That was the math of the market, about 21 to 22 times earnings. And actually the earnings came in better than I expected. So that was great. But all that to say, you are not paying too much for the S&P's profits today. Anybody who tells you that is just not looking at the data. And in fact, if you go to 2027 profits, because that's where we're going to trade the S&P at the end of this year, 2026, I believe that puts the S&P anywhere from 7,500 to 8,000 points. And I've told you my estimate's 7,720 for the end of this year. As long as the earnings story holds true, you're going to see these numbers happen. Even if we do have a correction or we have even a recession, recessionary earnings, the price that we pay for recessionary earnings naturally just goes up. So if price goes down and earnings go down, we may end up at the exact same P ratio. Who knows? If earnings go up and price goes down, maybe we're actually buying the S&P cheaper, and I think that's probably what's going to happen. So if you see a 20% drop in the S&P, just do some basic math here. We're probably buying the S&P now for 15 and a half times forward earnings. That is a screaming buy, and it's the exact same thing I told you in April of 2025 with Liberation Day. Is I said the S&P was a screaming buy. You could have bought the S&P in April last year for 5,000 points. So that's what the market does. We go from 5,000 to 7,000. Maybe we overshoot a little bit on the upside. Maybe 7,000 is too much to pay for the S&P. I don't know. We'll find out. And then in the short term, we go down to 5,500, and then you load up again at 5,500, and then we go to 8,000, and maybe 8,000 is too much to be paying for the S&P, and we go back down to 6,000. Who knows what the actual trajectory will be, but that's typically how the market works. For 200 years, we overshoot on the downside, we overshoot on the upside, and then earnings come in and people realize things aren't that bad. We're not relying just on big tech earnings. And I want to point this out to you that big tech, yes, is doing well. And I've got Microsoft, Meta, I've got Google in my personal portfolio, of course, just like our clients. All those stocks are tremendous companies. So I would not worry about those right this second. But from a valuation standpoint, we're seeing this rotation, and with performance, we're seeing a rotation to some of the more value-oriented names that we've kept in the portfolio that might have been a little bit more boring. Think about JP Morgan. Yes, came out a little bit down off of earnings, but earnings were still strong, $20 a profit. Could trade 15 to 20 times profit. And the stock's at $309. A lot of people think that stock's going to go up 20%. Not a recommendation. I'm not telling you to go buy or sell it or anything like that. But you're seeing this rotation through these value stocks. Pull up JP Morgan just to talk about these guys for a second. The past 12 months, JP Morgan is up 25%, not including the dividend, versus the S&P at 18.5%. All the people who are saying it's a Mag 7 trade or 7 stocks are driving the market or the top 10 are driving the market. They're just wrong. That's just not correct. And I can prove this to you with Goldman Sachs as well. Goldman Sachs is up 62% the past 12 months. Look at a company like GE, not necessarily an AI company, up 81% the past 12 months. We're seeing sector rotation. Again, this is the lifeblood of a bull market. It is good to see sector rotation. Let me go through a couple other names here. Caterpillar, not an AI company, up 75% the past 12 months. We talked about GE. Look at Citigroup here. Citigroup, probably the most boring company on earth, 55% return the past 12 months. Johnson & Johnson, okay, making baby shampoo, up 50% the past 12 months. You've got Morgan Stanley up 44%. And then, of course, you've got NVIDIA up 36%. But NVIDIA is number 20 out of the list of S&P 500 names the past 12 months. Eli Lilly, not an AI name, up 34%. Walmart up 31%. Of course, you have Oracle in there and Cisco, but look at Wells Fargo up 27%. We talked JP Morgan. Here's AbbVie, not an AI company. It's a pharma stock, up 25%. American Express up 20%. ExxonMobil up 18%, not even including the dividend the past 12 months. So all this to say, sector rotation is the lifeblood of the bull market, and sector rotation today is driving the stock market forward. We could see energy earnings surprise to the upside. I think you could see utilities earnings surprise to the upside. Healthcare has been through a bloodbath the past few years. You could see healthcare return in a big way in 2026. And if you have a diversified portfolio and you've got different sectors, you don't just have everything in high-flying tech stocks, you may not outperform every single year, but you're going to be consistent and you're going to see this bull market continue. The S&P is not just 7 stocks. It's made up of all these different sectors. Who knows what happens? Maybe rates do come down and Powell's feet are held to the fire and all of a sudden real estate does well. None of us know what the future holds. None of us can predict what's going to happen. But what I can tell you is all the data points to sector rotation driving the market forward. And I think that's why you're going to see the S&P hit new heights in 2026. All this to say, with a correction along the way, some people are going to say, well, Nick, what do I do now? Do I buy the S&P today knowing that a correction's coming, or do I wait for an opportunity? My advice would be, for the most part, you buy when you have the money. And you don't wait to try and time the market, because who knows? We could be wrong. Maybe there's not a correction. Maybe we keep rolling up to 7,800, 7,700, and then you missed out on that opportunity. So when you have the money, that's the time to buy. And then on the other side of the equation, I had one of my clients come in yesterday, and he said, Nick, there's been a change in some of our goals that we've had. And he actually watches the show every week, and he's like, I know you talk about goals-based planning, and the reason to sell, or the time to sell, is when you need the money, or when you think you're going to need the cash 12 months from now or 18 months from now. He did the exact right thing. And we talked in our meeting. I said, you know what? You were spot on. Okay, you did exactly what you're supposed to do, which is when there's a change in your goals, that's when we adjust the portfolio. So we're going to generate a little bit extra cash for him in the portfolio, a little bit of extra treasuries. So he's got that money safe, but the rest of the portfolio is still grow to beat inflation. And that's the time to sell, is when you're going to need the money. And hopefully you call us ahead of time. Give me 12 or 18 months. That would be helpful so we can get ahead of it for you. That's the time to sell, though. So it's not ever done off of market timing, emotion, reacting to the market. We never want to be reacting to what's happening in the financial markets or the press or the media or anything like that. We always want to be goals-based. We want to be proactive. We want to have our plan in place now so that when the correction comes, not if it comes, but when it comes, we don't have to sell stocks while they're down. And you ought to look at the way that your advisor does things. And I see this all the time, where a lot of advisors, they go into the portfolio, you need $100,000, and they don't sell from just the treasuries or the safe money. They sell across the entire portfolio pro rata. What a disaster. We've studied that over the years. That reduces return in a lot of cases by 0.3 to 0.5% per year. It's such a drag in the portfolio. So that's not a goals-based plan. That's a risk-based plan, a 60-40, a target date fund, all these different strategies that you've heard of. And a 60-40 is not necessarily bad, but it has to match your goals. And what I've found is the 60/40 sometimes, a lot of times, doesn't actually have anything to do with goals. It's just, this is the moderate portfolio. This is what we do for our clients that fit your profile. And there's no customization or attention paid to the actual plan that the client would have. And so that's why it's so important that you would have this goals-based plan. We would set safe money aside and truly keep it safe, that you would never blend your safe money with your risk money. You would never do the same thing with your risk money. You'd never try and keep your risk money safe. That would be so backwards. And if you do that, you get the math of the portfolio significantly goofed up. And you can't really grow enough in the good times. And then during the bad times, you still go down just as much as the market, sometimes even more than the market, because you're just not in the right asset classes to protect yourself. And it becomes a big disaster. So that's why we say be on a goals-based plan. Okay, now what else is coming for the rest of the year? I think the China-Taiwan story could be a big deal. We'll see. I hope it's not, but we'll see. But the midterm elections are another factor, and I would bet we probably get some gridlock in Washington, maybe not a ton, but that's very common. And that happened to President Obama. It happened to President Trump the first time around. It happened to President Biden. And I think it's going to happen this time around with the midterms. And I think what you're going to see is this just a little bit of gridlock to the point where in the short run, it could send markets down. Very typical in a midterm year to be volatile anyways. But when we get past the election time, I think the market's going to rally once we have some certainty of what's coming. And typically after the midterm election season, you get into 2027 and 2028, and those tend to be very, very positive years as well. So what do you do now in anticipation of a correction? What do you do if you're on a 2-3 year time horizon? Well, that's just it. You look at your time horizon, you get a sense for what are the goals I'm trying to accomplish. And if you've got 18 months, 24 months, you got 3 years, you got 4 years, just stay invested, because I believe when you look out 3, 4, 5 years from today, you are going to be up. And it's no different than owning a privately held company. Nobody who has a privately owned company cares about the stock price. In fact, a lot of times, if you just have a small business, there is no stock price because you never had a valuation done. And all you care about is A, making sure the business operates. Number 2, making sure customers are coming in the door so you have sales. Number 3, making sure you're controlling your expenses and your costs so that you're not spending too much and you're making a profit. And then over time, as you continue to make a profit, you build up your balance sheet. I can tell you for a fact, we work with a ton of business owners as clients. That's all they ever think about. They only think about sales, expenses, and build up a rainy day fund just in case times get tough. That's what smart, measured business people do. And there's no difference between that on a small scale. If you own 3 or 4 Jimmy John's franchises, if you have a couple of car washes, if you have some sort of widget business, it doesn't matter. If you're a manufacturer, it literally does not matter. There is no difference between that and a Fortune 500 or an S&P 500 company that's just doing it on a bigger scale. All those management teams, though, have gotten to that point because they are the biggest and best in breed. And that's why they're in the S&P 500. It's not to say every company is perfect, but I can assure you that these management teams are the best and brightest minds at the S&P 500 companies are worried about the same stuff we are. They're worried about China and Taiwan. They're worried about the midterms. They're worried about making sure customers come in the door. They're worried about controlling expenses. They're worried about making sure their stock price goes up. They're worried about all the same stuff that we are. And because of that, they're able to dictate the outcomes to an extent of where their companies go over time. And they can't necessarily control price. Nobody has control over price in the short term, but in the long run, they take care of their customers. They do a good job. They build up their balance sheets. They don't get wiped out when times get tough. And look at J.P. Morgan today. That's been the story of J.P. Morgan. And I've been reading that biography about Jamie Dimon, who has been basically a risk manager his whole life. And they built that business into almost $1 trillion bank now, if you can believe that. Absolutely incredible, astounding. And that's what they've done carefully over time. So Costco, we've used Costco as an example. What do you care about? You care about with Costco, not their stock price in the short run, but if they have 900-ish stores today, we want to see if they can get to 1,800 stores in the next 5 to 10 years. If Costco does $250 to $300 million in sales per store like they do Today, what do we care about? We want to see if their sales can go to 450 to 500 million per store by 2030 or 2035, whatever the target would be. That's the stuff we care about. We care about their growing membership base. Same thing with Netflix. All these companies, you can piece by piece go through them, and you can project out a reasonable growth rate. You can project out what we think cash flows are going to be worth, and then we can actually discount those cash flows back to the present, and we can figure out what the stock would be worth today. It's literally that simple. And I would just encourage you, just keep in mind that when you're in the stock market, it's not just the flying ticker tape across your screen. What is it? You have a claim on real assets. You literally have a piece, a tiny piece in a lot of cases, but a piece nonetheless, of all these different operating businesses, and they may go up or down, but over the long run, you're cared about the trajectory of those stocks. Just like the privately held companies, just like the small business person, they do not care about what their company's worth until they actually go to sell. And you ought to think like that too. The more and more that you think like a small business person as a stockholder, the better and better of an investor you become, because you understand the long-term objective. You keep cash for a rainy day to make sure you get through the bad times, and you hold your equities for the long run to make sure you can beat inflation. That's all I've got for you, episode 211. Remember, I keep telling you a correction's coming. Don't be alarmed. Don't be surprised. Let not your heart be troubled. And I'm happy to field your calls and emails and texts. That's what we're here for. But I'm going to remind you of the same stuff that I told you on the show today, which is stay on your plan and just stay on course here. And things will eventually rebound, and we will hit new all-time highs either this year or probably sometime next year. And we'll see you next week for episode 212. Thanks so much for being here.